Hello, welcome to the second blog on the outlook for small cap equities as viewed by SW Mitchell Capital. During March, we spent a lot of time on the road, and as a team we saw over 90 companies across a variety of countries, sectors and industries. I suppose the one common thread that we would take from all these meetings was the tone of management's outlook for the future. You know, throughout January and February, management seemed to still be quite shell-shocked, very uncertain about the outlook for their businesses for the rest of the year. Whereas in March we saw a marked change. The companies were much more optimistic about the outlook for the rest of the year. And I think, you know, we've obviously got the Q1 reporting season on both sides of the Atlantic coming up quite soon. And whilst the numbers themselves, you know, will probably be okay, I think much more important will be the tone of management's comments about the outlook for their businesses. And my view is very much that if the tone that we picked up in March and already at the beginning of April has continued in management outlook statements and maybe even in their guidance for the full year, markets could well have another leg up. I suppose the one question that we do struggle with is whether, you know, the top line growth at a lot of these companies, particularly in the cyclical areas of the market, is really strongly driven by true demand, or whether it's just inventory restocking. And I think this is a very difficult question, and one that we continue to try and probe on with all the managers we speak to. But I think, you know, regardless of that, we could see phenomenal earnings growth. There's a company involved in the steel industry who do foundries for the steel industry. We're basically seeing their utilisation. They obviously have an order book, seeing 95% utilisation for the whole of the first half of this year. They're not sure if that is, you know, real demand or inventory rebuilding. But they said if that continues, their EBIT margins for the year will be 12%. This compares to a previous all-time high EBIT margin of 8%. I guess a testament to the huge cost that this company have taken out. Now, this is just one example of the huge operating leverage we'll see in a variety of companies if we just get a little bit of top-line growth from here. So all in all, I suppose, you know, we feel pretty optimistic. We continue to find a lot of very interesting ideas. But equally, I guess on the short side, we still find interesting short ideas, particularly in the cyclical area of the market, where many valuations look just very, very stretched, and where, you know, the free cash flow generation we saw last year was purely driven by a reduction in working capital. And it's interesting to note that actually PricewaterhouseCoopers did some work on this. The majority of bankruptcies come as the economy, 9 to 12 months after the economy recovers. This invariably is companies, the top line explodes, they lose control of their working capital, and they then breach their debt covenants, and the banks are then happy to foreclose on them. So equally, we feel we should find some quite interesting ideas on the short side as well, but predominantly on the long side.